Hey there, and welcome back to the deep dive.
Good to be here.
So today we're digging into some really interesting source material all about navigating the markets.
Mm-hmm.
And we're zeroing in on something absolutely critical, but maybe, doesn't always get the main spotlight. Risk management.
Yeah, specifically how you handle risk when things don't go your way.
Exactly. Our mission for this deep dive is pretty clear.
Mm.
Pull out the key insights, the real nuggets of wisdom about stop losses and that whole tricky business of reentry.
Right, how to get back in, potentially.
Think of it as getting the essential toolkit for, well, keeping your trading account healthy and staying in the game.
And what's really fascinating looking across these sources is this core idea they push. It kind of flips the usual advice, doesn't it?
It really does. Instead of obsessing over finding the perfect entry point, the perfect setup.
Yeah, everyone loves the setup.
Right. They argue that real risk management, like the key to survival, actually starts with your exit plan,
Mm-hmm.
having that crystal clear from the get-go.
Okay, let's unpack that a bit. Why the exit? Why is that seemingly more crucial than, nailing the entry?
Well, the sources basically say, look, finding a good setup is great. That's your potential opportunity.
Sure.
But hardly anyone has a truly disciplined strategy for when things inevitably go wrong.
Yeah.
And they will go wrong sometimes.
That's where the stop loss comes in. And it's not framed as like, oh, I failed. It's positioned as a tool, a non-negotiable tool for taking control.
Control. How so?
It's you accepting reality, accepting the market doesn't owe you anything, right? It's going to move where it moves, whether you like it or not.
So using a stop loss, which just quickly, that's in order to automatically sell if the price hits a certain lower level.
Yeah.
It's not about being negative. It's being realistic.
Yeah.
Ruthlessly realistic, maybe.
Exactly. That's a good way to put it. It's fundamentally about preserving your capital.
Keeping your powder dry.
Yeah, keeping your account intact so you can actually trade another day, take future opportunities. The material sort of describes it like buying insurance.
Yeah.
It's a small defined cost, the potential small loss to prevent a, potentially catastrophic one.
Right, the big one that takes you out.
And crucially, hitting that stop loss. It creates emotional clarity. It forces you out of that specific losing position,
Okay.
which lets you step back, look at the market fresh, objectively, instead of being trapped by hope or fear or, oh, it'll come back.
But here's the classic pain point, isn't it? The thing everyone groans about. You set your stop, you get stopped out, and then boom, the market turns right around and rallies without you. It feels like you just locked in a loss for no reason.
Oh, absolutely. That happens, and the sources are really clear. That is part of the process. You have to accept that. The key mindset shift they push is moving away from, oh no, I missed the bounce, towards, okay, I'm out. Loss defined. Now I can assess if I should re-enter if the market confirms a new move up.
If it confirms, that's the key bit.
That's absolutely critical. You only, and I mean only, consider getting back in if the market is showing actual renewed strength, if it's definitively moving higher again.
So it's not just jumping back in because, the stock looks cheaper now after you got stopped out. That's tempting.
Precisely. That's highlighted as a super common trap. Trying to re-enter while things are still falling just because the price seems lower.
Yeah.
That's how those nice, controlled, small stop-loss hits turn into much bigger, really confidence-sapping losses. The market's giving you a signal if it's falling.
It's saying stay away.
Basically, yeah. It's telling you the risk is still high. You've got to listen and wait for that signal to change, wait for confirmation of a positive shift.
So re-entry, then, according to this thinking, it's a structured thing. It's part of the system, not just reacting emotionally because you feel you missed out.
Absolutely. The sources really stress this. Re-entry is a tool within your disciplined plan. It's not driven by regret or FOMO. You take the small loss, you gain clarity, you step away, maybe briefly, look again objectively, and only think about re-entering when your system, your analysis, whatever you use, indicates genuine, renewed strength.
Like maybe waiting for it to break a certain price level again, or seeing buying volume pick up.
Exactly. Things like that. Concrete signals, not just hope.
What about the alternative? What if someone just says, nah, I'm not using stops, I'll just tough it out, it'll come back eventually?
Well, the sources are pretty blunt about that. Holding on to a loser just a little longer is probably the fastest way to turn a small, manageable problem into a massive, account-damaging disaster. Any experienced trader knows this deep down.
And it's not just the money, is it?
No way. There's a huge mental cost. It creates immense stress. It makes you gun-shy on the next good opportunity. That one big loss can mess with your head, your decision-making, for ages.
So the stop loss protects more than just the cash in that one trade.
It protects your mental capital, your focus, your confidence, your ability to actually follow your plan next time. That's just as valuable.
It really reframes the goal, doesn't it? It's not about having a perfect batting average.
Which all.
It's about surviving to play the next inning, metaphorically speaking.
Exactly. Trading is all about probabilities. You are guaranteed to be wrong sometimes, often even, but by managing your risk rigorously, using tools like stop losses, you make sure you stay in the game. You survive those inevitable losses, so you're still around when the probabilities do work out in your favor on other trades.
That's how you compound gains long term.
That's the foundation, yeah.
Okay, so wrapping up this deep dive, the huge takeaway from this material seems to be stop losses are absolutely essential for survival. Full stop. And you need to couple that with a controlled, disciplined approach to re-entry. No jumping back in emotionally. Wait for the market to tell you it's time.
Right. It's about accepting the market's reality and just making sure you're still standing, ready for the next opportunity.
Success isn't about being right all the time.
It's about being resilient, managing the times you're wrong effectively.
And the final thought from these sources, something really potent for you, the listener, to mull over. It ties it all together perfectly. You don't have to win every trade. You just have to survive every trade.
That's what stop losses do. And if the market turns back in your favor, you can always re-enter this time with the wind at your back.
Ponder that idea. Survival over chasing perfection.
It really could change how you think about managing risk in your own trading.